Good morning, everyone. My name is Adam Livingston, and I am the Bitcoin Wizard. We have a very fun one for you today because JPMorgan is literally putting out a Bitcoin price target of $165K. And we're going to be talking about the so-called dollar debasement trade. Wall Street is finally waking up and smelling the melting currency printer. So today we are going to christen the dollar debasement trade, the greatest wealth migration since medieval peasants realized that gold beats turnips as a store of value. Uncle Sam's chain smoke and deficit bills behind the Capitol, Treasury auctions are turning into yard sales, and the Fed is pouring pixel money onto the bonfire while telling you that inflation is transitory. In this glorious dumpster fire environment, even the button-down analysts at JPMorgan, they have had a come-to-Satoshi moment, admitting that gold and Bitcoin belong in structural portfolio slots, not the fun speculation bucket anymore. When the world's biggest bank starts preaching my lines, you know that the clown show is entering its final act. So this is what I'm going to go over the next 7 slides. I'm going to break down the numbers, expose the fiscal horror movie playing out in Washington, and prove why Bitcoin is not just going to keep up with gold, it is going to speed run past it on a rocket powered by deficits, real rate suppression, and the collective nervous breakdown of every central bank on Earth. The debasement train is leaving the station, and there is no stopping this train, okay? The first class tickets are denominated in 12 decimal places. Once again, a very special thanks to Horizon for sponsoring this video, because Horizon helps you buy Bitcoin using your home equity without debt, monthly payments, or term limits. The Bitcoin is fully yours to custody however you would like, with no risk of forced liquidation. They're linked down in the video description, and I will talk more about them at the end of the video. So here we go, slide 2, JPMorgan's core thesis. And I know what you're thinking, did JPMorgan really flip the script on Bitcoin, or did I accidentally drink store brand NyQuil? Yes, friends, the same bank that once called crypto rat poison in a hoodie now writes love letters to Satoshi on company letterhead. And here is why. First, they are coming out and admitting that the dollar is not a reliable life partner anymore. It is a Tinder date who raids your fridge and Venmos itself cab fares from your phone. Their research deck has conceded that structural hedges are necessary, which is a translation for saying gold and Bitcoin get permanent desk space next to their Bloomberg terminal. The note even quantifies the awkward truth. If Bitcoin merely closes the volatility adjusted gap to gold, we're staring at $165K per Bitcoin. That is not hopium, it's simple relative valuation math, the kind that analysts use when they're afraid of getting roasted in front of Jamie Dimon. Now, second, the flood of money is already ankle deep in their lobby. Nearly $80 billion poured into crypto products in the last 2 years, and a very fat slice came through Strategy's corporate raids on the spot market. If the suits are running this fast before the fire alarm even rings, imagine the sprint once the sprinklers actually start. And finally, JPMorgan also tips its hand on the retail on-ramp, which are spot ETFs. They make buying Bitcoin as frictionless as grabbing an index fund, except the index in this case is pure monetary defiance. That's the syringe that's injecting Bitcoin straight into every 401k on planet. And yes, the inflows of the spot ETFs are insane. The #1 most successful ETF launch of all time is IBIT. So remember, when the largest US bank built on leverage, Basel III gymnastics, and a prayer, they tell their clients to own the assets that drain its own moat, you have to ask, what do they see on their risk dashboard that we haven't yet? Well, it's a tsunami of deficits, real rate repression, and the slow extinction of the trust in the fiat system. So grab your digital surfboard. Time to lift the hood on Uncle Sam's current debt situation to spell out what all of this means. The federal budget has turned into a reverse alchemy machine, converting taxpayer cash into a steaming pile of IOUs at a record pace. Fiscal year 2024 closed with a $1.83 trillion deficit, and the Congressional Budget Office is already penciling in about $1.9 trillion for 2025. So apparently, money just grows on press releases. Here is the part that would make the sober accountant reach for the bathtub gin. Net interest on the national debt is now outrunning both defense, and Medicare spending. Yes, the net interest outlays hit $514 billion in the first 7 months of fiscal 2024 alone. I want all of you guys to think about that, okay? We spent more servicing yesterday's pizza than protecting the country or patching grandma's hip. Better yet, more than 1/3 of all marketable treasuries mature within 2 years. So the treasury will soon then roll that paper at whatever yields the bond market demands, kind of like refinancing a payday loan during a credit crunch. And the bond vigilantes have totally noticed duration premiums are creeping back, real yields cannot rise without detonating the budget, and every auction looks like a garage sale where half the bidders are just there for the free donuts. Investors are not waiting to see if Congress suddenly discovers fiscal discipline. That's not happening. They are front-loading hedges right now, swapping the fragile coupons for rocks and code because they know math only gets uglier. So this is the bottom line. The engine that powers debasement is a V8 burning deficits instead of gasoline, and the driver is flooring it on a road marked inflation ahead. And if you are still wearing a Fiat seatbelt, now might be a good time to unbuckle and grab the hard asset parachute. Now it's time to talk about inflation and the real rate context to this monetary policy twilight zone so we can fully understand what's going on, because right now, these numbers are pretending to be facts. What do I mean by that? Well, the 10-year break-even inflation rate currently sits at 2.35% as of October 7, 2025, and that is straight from the Federal Reserve's website, which is obviously a friendly little lie. We all know that inflation is much worse. We can feel it in our bones. The dollar menu, my beloved Taco Bell dollar menu, has totally disappeared. This lie is just whispered by bond traders who collect fees whether the world ends or not. And if we look at the 10-year treasury yielding about 4.2%, that means your inflation-adjusted return is a heroic 1.8%, give or take, barely enough to buy a latte in 2030 after shrinkflation reduces your coffee to just brown steam. Now, this is the ultimate master overview, okay? Are you paying attention? Washington cannot let real rates climb much higher without detonating its own budget. Remember the last slide. The interest costs already outrun defense and medicine. If yields drift toward 5 or 6%, the federal balance sheet becomes a bonfire that even the IMF would live stream for fun. The Fed knows this, the Treasury knows this, and JPMorgan's research interns definitely know it because they keep ordering espresso at 2 o'clock in the morning. So the system solves the problem the old-fashioned way. We all know it just inflates the debt away. That is polite economic jargon for slow-motion theft from people who want to save their own damn money. Investors see the scheme, so they treat gold like medieval insurance and Bitcoin like insurance with a turbo button. When real rates flirt with zero, these assets moon. When real rates turn negative, they hit escape velocity. In other words, every time Jerome Powell hits at a rate cap, I need you to imagine a neon sign over Wall Street that flashes buy scarcity now. It is no surprise why Bitcoin and gold are performing. The market is going to front run the Fed because the market always moves faster than a committee that debates the location of its coffee machine. The real yields roller coaster only has one direction after the next recession hits, and that direction is down. Now we're going to talk about reverse currency musical chairs. For 80 years, the US dollar has worn the crown, sipping umbrella drinks while every other currency polished its throne. But the IMF's COFR database shows that the greenback share of disclosed central bank reserves is about 57-point-something%, down 6 full points in a decade and nearly down 15% from the early 2000s peak. The king of all the currencies in the world right now, the US dollar, is still on the throne, but the king has lost his sword, his cape, and probably the royal credit score. And I'm not lying, Moody's actually downgraded the credit rating of the United States government, so that's not even made up, that's just reality. So why the slow exit of the US dollar? Because sanctions are the new drone strike, don't you know? Freeze the wrong nation's reserves and surprise, they start shopping for neutrality. Gold, rupees, even the Swiss franc, anything that isn't weaponized by a Senate subcommittee. Second, the US fiscal circus we covered earlier makes the foreign treasurers nervous. Would you park your rainy day fund in an IOU issued by a government that can't pass a budget without a reality TV cliffhanger? And then you enter the central bank gold buying, which is running at a pace that would make King Midas blush. Even after last year's breather, the net purchases remain well above the pre-2022 average. Picture dusty vault doors creaking open from Ankara to Beijing as pallets of gold bullion slide in like their Costco shipments. And this is the ultimate plot twist. Those same policymakers are quietly exploring their digital bearer assets. A handful already hold tiny Bitcoin allocations that they call research projects, the bureaucratic term for don't freak out the bond desk. The moment one mid-tier sovereign publicly admits to stacking sats, the game theory ignites faster than a meme stock on Wall Street bets. So the takeaway is very simple. The dollar is not going to die tomorrow. It is a long, slow death, but it is certain and it is happening. The trend line is heading south and it will forever, kind of like retirees going to Florida in February. Gold and Bitcoin are the lifeboats and the crew is quietly lowering them while the passengers are just sipping cocktails. When the band starts playing Nearer My God to Thee, you'll be glad that you claimed a seat early. So we're going to shift our gaze from pixels to precious metal because our old friend gold, yes, you're welcome Peter Schiff, we have just smashed through the $4,000 ceiling like a WWE wrestler crashing through a folding table. Yes, this is the first time ever gold has cleared $4,000 an ounce. So if we look at the scoreboard, looking at the Q2 2025 demand, it has hit 1,249 metric tons, which was up 3% year over year, which is worth a jaw-dropping $132 billion, which is the largest quarterly dollar value in recorded history, making the World Gold Council spreadsheet glow brighter than the bullion itself. The gold ETFs that were once hemorrhaging the ounces like a leaky bucket have now guzzled roughly 588 tons so far this year. This has been the biggest buying binge since the lockdown stimulus checks turned Redditors into gold bugs. Central banks are the real party animals, folks. Think China, think Turkey, think Poland. They're all looking at their towering US Treasury stacks and saying, no, give me something that I can physically drop on my foot. So why this gold frenzy? Well, it's real simple. Because real rates, remember, are on life supports. The deficits are drinking Red Bull, and geopolitical trust in the United States government is lower than a crypto influencer's credit score. Gold offers analog scarcity that you can literally trip over, and that scares the fiat currency negotiators a lot more than a polygraph test. Now remember, Bitcoin is the digital escape pod, but gold is the vintage Cadillac waiting in the garage, which is a little heavy, sure, but it does start every time the monetary engine sputters. Institutions know it, hedge funds know it, and apparently your dentist knows it because bullion dealers now have longer wait times than elective surgery. If the yellow metal keeps inhaling demand at this pace, we may need a bigger price axis before the holidays. Now we glide from shiny prehistoric rock into the blazing digital meteor that is Bitcoin. We all know that Bitcoin has kicked in the door of Wall Street like it's a damn SWAT team with laser pointers, and the evidence is just in the flows right here. First is the spot ETF tsunami. Since the SEC grudgingly blessed these wrappers, investors have shoved $60 billion into them, and we have already logged multiple $1 billion days just this month. There is a fire hose hooked up to the Coinbase order book, set to full blast while TradFi compliance officers are screaming risk limits in the background. Folks, I don't know if you have seen this, but it is just the truth. The Bitcoin supply on exchanges have now reached another all-time low. Second, we're going to look at the derivatives volcano. The CME futures open interest just printed a new all-time high, and the options market for Bitcoin right now literally looks like a Las Vegas sportsbook the night before the Super Bowl. All of these grease-painted quants yelling Greek letters and praying their Delta hedges survive the weekend. There's the corporate treasury arms race, which I don't want to get into too much because we all know that Strategy holds roughly 640,000 Bitcoin, which is enough digital property to buy Delaware in a pullback. Every CFO who used to brag about a 5% cash buffer now looks like a Victorian ghost clutching a purse of tarnished shillings. And we just got to talk about this valuation gap gap because remember, JPMorgan's own math says Bitcoin needs a 40+% pop to $165,000 just to reach gold's risk-adjusted footing. That is the kind of upside that turns a risk manager's ulcer medication into a subscription service. If you put all of this together, what you have is a liquidity vortex that feeds on deficits, low real rates, and an institutional fear of missing the next monetary epoch. Bitcoin is no longer digital baseball cards trading in your basement. It is a regulated QSIP-wrapped battering ram at the gates of every 401k and endowment portfolio. Right now, the question is not whether the floodgates open. They already have. It is very clear. Just look at the statistics. The question is whether you own enough life preservers. Because the water level's rising and the tide shows no interest in respecting traditional asset allocation charts. Real quick, before we get to the end of the presentation, folks, I found this article from the Federal Reserve website. The Board of the Governors of the Federal Reserve System literally posted this article, The International Role of the US Dollar, the 2025 edition. It's really funny. They're bragging about the US dollar over the last century, how dominant it is compared to other currencies. And I'm telling you, as you scroll down this entire article, every single graph and chart that you see just makes you understand that the US dollar is terminal and you cannot save it. They're showing the gold reserves spiking in foreign treasuries while they're showing the foreign holdings of the US government debt go down from about 60% to in the 30s. You can scroll through this entire thing and it's hilarious. They're bragging about the money printing. They're showing how stable coins are taking over. Right now, the Tether's market cap, as you can see, went from, what is that, $25 billion about in 2021 to 150. So casually 6xing. They are literally spending this entire article showing why the Federal Reserve is just going to be archaic. Anyway, just thought I should show you that. I think you should all read that. It's very interesting. It's coming straight from the horse's mouth. None of this is my opinion necessarily. Now, this is a bit of a watch list that I have created. It is not necessarily my advice for an investment allocation mix. This is more so what I believe these banks will start to kind of recommend. I think if you picture a portfolio where the hard assets equal about 20% of the calories, maybe 12% gold, 8% Bitcoin, that might be realistic in the near-term future. I think stocks are still going to wear the crown. Bonds will go down. I think 25% bonds is still way too high, obviously. I think in the near future, gold and Bitcoin will be the guards standing at the gate. They're going to say to size your Bitcoin with your risk budget, not your fear of missing out. They're going to talk about the volatility. That's not going to go away in the near-term future. But in the meantime, I'm just going to dollar cost average like an absolute monk. I'm going to keep my daily Bitcoin buy happening. And as market understanding of Bitcoin continues to happen, as we really realize that it is the risk-off asset, that's when you're going to see the rebalancing really start to happen, where they're going to realize, oh, it's probably smarter to be 100% into Bitcoin. Or if that's not your speed because it's an infinite duration asset, well, you can buy one of Michael Saylor's preferred instruments. That's eventually where this is all going to go, but we just have to wait. We have to wait for the market to catch up to this. We are way ahead. If you are a Bitcoiner, you understand that. This is kind of the apocalypse bingo card that I made. Monthly deficit prints. If the comma moves, so should your hedge ratio, obviously. We all know that the money printers are going to print, so I just say front run as much as you can. But remember, this is not financial advice. This is financial entertainment. It's going to be fun to watch the treasury auctions, the gold and Bitcoin ETF flows, the IMF for USD share, the real yields on the 10-year treasury. All of these are going to be so fun to watch as we look into the next monetary apocalypse that we are on the precipice of. Not to be too alarming, but hey, I just think it's reality at this point. At the end of the day, in my humble opinion, I really think that you should buy Bitcoin in this environment because it is the risk-off asset. Thank you so much for watching. My name is Adam Livingston. I am the Bitcoin Wizard. If you like this content, please like this video and subscribe to the channel. It really helps me spread the orange gospel to the masses. Have a terrific day. Do not party too hard. Class dismissed. Once again, a special thanks to Horizon for sponsoring this video. Most people do not realize this, but on average, 60% of American homeowners' net worth is locked up in their primary residence. And with home prices more inflated than ever, Americans now sit on a combined $35 trillion in home equity. Now, Horizon is offering you a way to unlock that trapped capital and put it to work in Bitcoin. Horizon helps homeowners unlock a portion of their home equity to buy Bitcoin. It is not a loan, so there are no new monthly payments. You keep living in your home as usual, and then later, when you sell, refinance, or choose to settle early Essentially, Horizon's provider takes an agreed share of your home's future value. That is the trade. Unlock cash now to stack Bitcoin by selling a slice of your home's future value while you continue living in it. What makes Horizon stand out is that there are no term limits and you keep 100% of the Bitcoin upside. The Bitcoin is fully yours to custody however you want, wherever you want, and with no risk of forced liquidation. If you've been sitting on a pile of your home equity and are eager to invest in Bitcoin, this may be the product for you. Visit joinhorizon.com to see if you qualify and get started. Their team of experts will work with you one-on-one from start to finish. Transform your dormant home equity into Bitcoin today with Horizon.